Navigating the world of landlord taxation can be complex, but understanding it is crucial for your property rental business. This guide will help you manage your tax obligations efficiently and potentially reduce your tax bill. As a landlord, you must report your rental income to HMRC on a tax return and pay tax on your profits. However, there are several ways to minimize your tax liability legally. Let's explore the key aspects of landlord taxation. First, let's talk about allowable expenses, which form part of your self-assessment tax return. These are costs incurred wholly and exclusively for your property rental business that you can deduct from your rental income. These include letting agent fees, safety checks, and professional fees like accountancy services. By claiming these expenses, you reduce your taxable profit. For landlords with mortgages, there's the Residential Property Finance Cost Tax Credit. While you can no longer deduct the full amount of mortgage interest from your taxable income, you can claim a 20% tax credit on your finance costs. This credit is applied against the lower of your finance costs, rental income profits, or adjusted rental income after deductions and reliefs. It's important to note that you can claim pre-letting expenses if they were incurred within 7 years before starting your rental business and would be deductible if incurred after the business began. This can include costs for preparing the property for rental. To calculate your taxable profit, add up all your rental income and subtract your allowable expenses and any applicable capital allowances. If you make a loss, you can carry it forward to offset against future profits from the same property rental business. The tax rate on your rental income depends on your overall income, including salary and other sources. You may pay no tax if your total income falls under the personal allowance, or you could pay basic rate at 20%, higher rate at 40%, or additional rate at 45%. As a landlord, you need to register with HMRC for self-assessment and file a tax return each year. If you're new to self-assessment, you must register by the 5th of October following the tax year in which you started collecting rent. Purchasing or transferring rental property ownership to a limited company can be worth considering for some landlords. Being a limited company landlord can help you reduce the rate of tax paid on rental income and potentially reduce inheritance tax. For those with annual property income that falls within the property allowance, you don't need to report this income or pay tax on it. The property allowance currently gives an exemption on property income of up to £1,000 per tax year. Landlords should be aware of how the HMRC initiative called Making Tax Digital will affect them. It is set to be implemented from April 2026 for some landlords and will require landlords to submit records to HMRC more regularly, keep digital financial records and only use compatible software. This will involve keeping digital records and submitting quarterly updates to HMRC. Understanding and managing your tax obligations as a landlord is essential for maintaining a successful property rental business. By staying informed about allowable expenses, tax credits, and reporting requirements, you can ensure you're paying the right amount of tax while maximizing your rental income. You can find out more about tax rebates, and use free tax calculators at www.taxrebateservices.co.uk. The content used in this video is intended for educational and informational purposes only and does not constitute advice. We recommend that you do your own research on each subject and take advice from HMRC or a professional tax advisor.